Hello traders, this is Fawad Razakzada, market analyst for City Index. Today is the 11th of April 2024. The Nasdaq has been finding support from this shaded blue area between 17,760 to 17,860 area in the last couple of weeks. And so far, we haven't seen any significant downside follow through despite the price action being far from ideal from a bullish point of view. For example, we've seen two bearish engulfing candles in recent times, but so far what's been lacking is downside follow through. Will that change? Remains to be seen, but right now, at the time of this recording, the Nasdaq was testing resistance at around 18,100, which has been a pivotal short-term level. The 21-day exponential moving average, which has now broken down, is also coming into play at around 18,100 area. So that could be an additional factor that could prevent the Nasdaq from rising more significantly from around these current levels. So where do we go from here? Well, from a bearish point of view, I think we'll need to break this support zone down before we can turn tactically bearish on the market. But we have seen a few bearish price patterns in recent times, as I mentioned. The Nasdaq is looking somewhat neutral, but if you look at the other major indices, for example, the S&P 500, this one has broken its short-term trend line. In addition, it's moved below the 21-day exponential and it's made a couple of lower highs ahead of the bank earnings, which will be released on Friday, with reports from JP Wells Fargo and Citigroup due to be released. So the focus is going to turn towards earnings, but inflation remains a big concern in the background, given the fact that CPI has now overshot expectations on 3 or 4 months in a row now. Crude oil prices have been rallying sharply of late, albeit they're down a little bit today. But nevertheless, rising oil prices, if they remain elevated at these levels, they will fan inflation concerns and keep bond yields elevated for longer. So that's the key risk facing the markets at the moment. But if earnings do come in weaker as well, that is an additional factor that could prevent the stock market from going further higher from here. So that's the situation with the S&P 500. If you look at the Dow Jones, well, this one has started to break down more decisively compared to the other two, following its double top formation just below the 40,000 level. Since then, we've seen a break below this support line at 39,285, which has since turned into a resistance, and we've had a couple of lower lows form as well. So there are some indices that are looking a little bit weak. The other one here is the German DAX index, which fell further on the back of the ECB's rate decision today. Although the central bank kept interest rates unchanged, the tone from the ECB's press conference was that nothing is guaranteed and inflation could accelerate again. Is a risk that ECB President Christine Lagarde highlighted. So right now the DAX index is testing this medium-term bullish trend line that has been in place since October of 2023. Recently it broke below its shorter-term bullish trend line that caused the market to move down below its 21-day exponential. So all the attention of today will be on the medium-term bullish trend. If it can close below this as well, then that could pave the way for a deeper correction, possibly all the way down to this high that was created in December at around 17,000. Now, looking at gold prices, in my previous video, I had highlighted the RSI being at extremely overbought levels on multiple timeframes, including the monthly here. But also, if you look at the weekly timeframe, the RSI is well above the 70 threshold. A bit of profit taking should not come as a surprise here because of the strength of the rally we've seen of late. And the fact that bond yields are continuing to rise, which had been ignored by gold investors up until now. But if the rally continues, then at some point that will need to be addressed. And around current levels, I think there is a risk of a pullback. It will not necessarily be the end of the bullish trend line if we see it, but it will nonetheless allow the overbought conditions to be worked off. So a bit of a pullback perhaps to the bullish trend line on this daily time frame would be a healthy sign should it come. Following the stronger than expected CPI report from the US on Wednesday, the euro dollar finally broke through its bullish trend line that had been in place since October of last year. And today we had PPI data which came in mixed, causing the euro dollar to extend its falls. It's now testing this support zone between the lows that were formed in February of this year and December of last year, around this area, around the 107 handle. And this area is an important pivotal area. A close below this zone could pave the way for a move towards 106 handle, possibly 105 thereafter. On the upside, broken support levels, for example 107.95, will now be resistance or key resistance levels to watch. I had highlighted this consolidation pattern on the dollar yen as a bullish signal, and thanks to the stronger inflation data from the US, the dollar yen finally broke above the 152 handle, hitting fresh multi-decade highs. It is now above 153 handle and climbing towards that 155 handle, a level where many people think that the Japanese officials may intervene in the FX market. So let's see if it will get there and what kind of a reaction, if any, we will get from the Bank of Japan or the Japanese Finance Ministry. For more analysis and trade ideas, make sure to check out the news and analysis section at cityindex.com.